All right. Good morning. Good afternoon. So this video will be on order flow. So it's like an introduction to order flow, and this will be needed. The basic understanding of order flow is needed to align yourself with the direction of the market, which is generally called bias, and understanding order flow of a market. Understanding as the order flow of an asset class, it helps you streamline your entry and your exit. It helps to make your narrative less complicated because you can twist this marketplace back and forth to see what you want. So if the market is predisposed to go higher, you can by yourself create illusions to make you see this market as a bearish, to make it seems like it's bearish. Meanwhile, order flow is actually bullish. So in this same sense, this is why you need to understand basic order flow to understand bias. So hence this teaching. So what is order flow? So when a order flow is basically what program is being executed in the marketplace. Mostly we deal in the higher time frames. So when a higher time frame program has been established, like has been seen, for example, a buy program is being executed by the algorithm, that means you want to see higher prices. But because the market does not go one direction just like that, there must be manipulation in the marketplace. And this manipulation, when it takes place facing the opposite direction on the intended marketplace, on the intended program. So doing this manipulation, when price retraces, it goes to balance and imbalance or or go into another block. So when using this for example, when this last down close candle was made, when this candle was made, you map out the eye of the candle. So this right here, this is the order block that pierced sell side liquidity, that pierced sell side liquidity here. So doing this last down close candle, smart money was filling their buy orders. They were filling their buy position. So and then price expanded higher. Would talk about element of a trade setup. That should have been the second lesson after the market efficiency paradigm, but it did skip my mind. But we'll talk about it inside the mentorship because you must understand the elements that constitute a trade setup to understand order flow because it also streamlines your expectation in the marketplace. You don't be going up and down and confused on what the algorithm is likely to do next. Because if it's algorithmic, that means all its signature must be a programmed signature, must be something that can be predetermined. Yes, you can be off at times, you can miss the direction, you can be away from the market and lose your touch from it. But that happens and that is acceptable. So back to this. So doing this last down close candles, smart money was buying here. But because smart money orders are large, they are bulk of orders, so they cannot enter their full position here at this last down close candle. So they will enter majority of their position here. So when price expanded to the upside, this last down close candle now will be of interest to smart money traders, because their this was where they last entered their buy position, because their drawn liquidity is buy side. They have purged out sell side liquidity and they are interested in buy side liquidity. And when you are interested in buy side liquidity, that means you are expecting higher prices in the marketplace. Let's let's indicate this because it will be needed to understand this order flow that we are talking about. So when smart money traders was buying inside of here, they were buying to offload at this place. They do not know by which date their position will be offloaded. What they know now is they are dealing in the present to offset the future. So this when they were buying here, when price expanded higher, we expect a form of retracement in the marketplace. So when price consolidated here, then expanded higher, they were expecting a retracement. So price swept buy side liquidity here, this is buy side liquidity here, and price was interested in sell side liquidity. Smart money always buy at a discount. When they are interested in going long, inverse this logic for short. So when smart money traders are interested in going longs, they look to purge out sell side liquidity. They look to pair their long positions with sell stops, because this is what makes the market efficient. It is efficient for smart money traders to use the liquidity from uninformed money, to use it as a counterparty for their orders, for their buy orders. So when price retraced back down here after this expansion leg, price came down for this swing low. If you zoom in your price, if you zoom into your chart here, you see this swing low. The swing low consists of 3 candles. So you see this is the swing low. So price came down and took out this swing low, which corresponds with this bullish order block where smart money traders last took their orders, their buy position. So when price does expand higher again, but as you can see, because this was the last down close candle, this order block here, this now is a bullish order block. This order block now is of interest, even though your attention will be focused on this order block. So this order block. So order flow for a buy narrative, for a buy program, last down close candles should support price going higher. So with the classic support and resistance logic, when bullish, down close candles should support price going higher, and up close candles should resist price from going higher and support lower prices for a sell program. So when this so because this is the order block that is of interest, when price came back down into it, smart money traders they filled their buy position as price was dropping down inside of here. So let's call this number one. Let's call this one. So let's call this one because this was when smart money traders was first entering their position. And when price retraced here after this expansion leg, they entered here also. We'll call this 2. Now, if we are expecting higher prices and price starts to form something like this, a form of retracement, and leaving clean highs like this, which corresponds with your draw on liquidity, this buy side liquidity, it will be noted that that drop in price, that retracement in price is a manipulation leg. This will make uninformed money see this as price taking out this buy side liquidity and wanting to come down below these lows and these lows. But because the narrative is bullish, because the narrative is bullish and the program that is being executed by the algorithm is a buy program, when price does retrace back down here, you note the last down close candles, this other block here and this other block here, this last down close candles that you expect to be acting as support for price. So we note this last down close candles. I'm currently using the open of the candle, the midpoint of the candle, and the close of the candle. So and these are the prices for it. When you are bullish, a discount PDRA should be giving you a story of a buy narrative. And for a buy narrative, I made a video on anatomy of PDRAs. For PDRAs, when for a discount PDRA, when you are bullish, when price trades into that PDRA, you want to see the bodies telling you a story of a buy program. That means, what do I mean by that? That means you want to see the close. Every candle close should be above the midpoint of that candle. Every candle close should be above the midpoint. It shouldn't go below, any close shouldn't go below the third and into the fourth quadrant. You want to see close, majority of the close of the incoming candles, the new candles that will be formed, to be close above the midpoint, above this 50% of this. And during the year we had FOMC. We have FOMC released here on May 1st, which was on a Wednesday's trading. So because we had FOMC here and we're waiting for a retracement to go higher, when price made this retracement and left this last down close candle, which smart money was buying, when price was coming down below here, smart money trader was buying all of this because this is the long-term low, this is the intermediate term low, and now this any low we indicated from the market structure video that during the intermediate term low or an intermediate term high, price will leave an order block or a fair value gap, which is a form of imbalance. Price will leave it to allow smart money traders to pyramid their position at a future time, at a nearby future time in price, to facilitate more buy entries. So here you have this position 1, which was filled, and which is the long-term low. Then price made an intermediate term low. Now, if you are bullish, you do not want to see this low violated. You do not want to see it violated. because this now is an intermediate term low. So you want to see price respect this order block, and price does it here and rallied higher like that. So for order flow, you want to see down close candles. For a bullish order flow, you want to see down close candles supporting price going higher like this. When price reaches down to this last down close candle, price rallied higher, then retrace back down to this last down close candle and rallied higher continuously. That's what it does. So as you can see, because we are still bullish, price came down to purge out sell side liquidity here. This last down close candle now is the bullish order block. So let's make this. So this last down close candle now is the bullish order block. And as I said earlier, when the narrative is a bullish narrative, when the program being executed by the algorithm is a buy program, every down close candles should support price. When I say every down close candle, I do not mean just down close candles just like that, because this is where the people that I generally call SMC traders, because they've deviated from the ICT's concept, what ICT is trying to teach. SMC traders do not trade with logic, they trade patterns. So when they are talking of down close candles, they are looking at all of these down close candles, every down close candles. They're expecting every down close candles to be an order block. That is not how it goes. There is more to an order block. There is you have to have a very deep understanding of order blocks to understand that this is where smart money traders were entering their last position, because you want to be in line with them. You cannot beat them. If you cannot beat them, you learn how they think and you join them. Does that make sense? It doesn't mean that you join their operations off the chart. I'm talking of inside the marketplace currently. So if you can't beat them because your logic, what you've been told, does not work, so you have to join them and think like them. This is why those last down close candles, like I explained earlier, those last down close candle was where they last took their buy positions. Then when price rallied higher, we expect a form of retracement downward into the last down close candles, which is this order block. So price did that here and rallied higher. As you can see, this is it. So to understand order flow, you must have a bias. You must have a draw on liquidity. You must have a draw on liquidity. When you have a draw on liquidity, that is obvious, that is a very clear point of liquidity or a form of imbalance that price is trying to trade back into, that price is trying to rebalance. It will help you streamline your understanding of order flow. Do you understand? Does that make sense? So it will help cement your understanding of order flow. So when you've identified a bullish order block, the last down close candle, where smart money traders was entering their position, you will note that as a point of interest for you, that this is where you want to participate in the marketplace. So that is a brief explanation of order flow. I will make a second part of this video because there is more ways for you to see order flow. You understand? There is more ways for you to view the marketplace to understand a order flow that a program that the market is currently executing. Because the algorithm cannot hide its signatures. So because of that reason, there's specific ways that you can identify a form of order flow, especially when you have a choppy price action. A choppy price action. The next video, the second part of this order flow will be about will help when you are dealing with choppy price action, because it is derived from the basics of liquidity. If you did understand the video I made on liquidity, then you will understand what we're about to talk about next. So like I said before, for order flow, every down close candles we act as the support level to take price higher. This was the last down close candle where smart money traders was buying when price was trading here. This candle, when it opened here, when it was coming lower below this low here, it was a down close candle. It was black. It was a black candle. And during this time, smart money traders was buying. Because they were buying, that means this is the last down close candle. This is the order block that price is interested in. So you know this as the order block. That means price is interested in coming to this low. I'm not saying it will bounce from this low. I'm saying price is interested in coming to this low. So you can use the understanding of order flow to streamline your bias, your intraday bias. I hope you got something from this video, and talk to you in the next episode.